What a great morning. Love the tone, great insights. So for those of you who don't know, Deloitte has been engaged in blockchain digital assets. This is our 13th year, which we're very proud of. And we do serve the entire ecosystem. A lot of the voices you heard this morning, we serve miners. There's a lot of brokers out there, both TradFi brokers and then new brokers in digital assets. A lot of the investor side, pretty much everybody in the ecosystem, which makes it really fun to serve in this space. So as Amy mentioned, Rob Massey, I don't know, maybe that's the clicker. Rob Massey, I lead our practice. I was the first one in our firm to start doing this literally 13 years ago. So it's neat to be doing it all this time and lead everything we do in tax and around the world. Conor.
And I'm Conor O'Brien. I'm a senior manager in our Washington National Tax Office. I actually came back to Deloitte at the beginning of 2018 to work with Rob in our BDA practice. And I've been in our national office for the past 3 years. I spend 100% of my time on blockchain and digital asset issues. So we get really deep into these topics, and I think we're probably some of the best, or the best in the tax space to really advise on these topics because we get so deep.
We'd like to think so, right? And so, and an example with Conor, to think about tax, you really have to understand the tech, right? You can't really put a tax lens on it unless you understand the nature of these transactions. And so we try and bring that to everything that we do. So over the last 13 years, we've learned a lot. We've served a lot of different transactions, different clients. So we recently put it into a book. So some of you are familiar with B&A portfolios in general. This is a treatise that covers lots of traditional tax topics. Bloomberg owns this currently and has done this for many, many years. And there are chapters and treatises that cover different topics. There's now a crypto treatise. This is almost 400 pages, and it covers a lot of the things we've done over the last 13 years and lessons learned. So it gets a little technical. It does reference case law because there's not a lot of rules on point. And as Betsabe said, if you want to go far, you do it together. I love that quote, by the way. This is 50 authors and contributors over 2 years that put this together. So we're really proud of what the B&A represents. It covers a lot of stuff. It covers corporate transactions. If you're funding companies all of a sudden using crypto, it covers unique transaction types, which we'll get into a little bit. What about multi-state? Do we think about sourcing, heavy international components, crypto comp, and all the rest of it? So there's different chapters in here that cover it all, which I think it's a great reference guide. This will continue to be updated. A month ago, we got new Treasury regs. Sorry, it's not in there yet. We're working on a little update. Hopefully in another month, we'll have that in there. And so the online version will be continually refreshed. It is owned by Bloomberg. There's a paywall behind it. Most tax departments have access to B&As anyway, but if you don't, they can get you a license.
Yeah, and I think this was really a major update to the product that we had because of the prevalence of smart contract enabled networks and decentralized applications. There's just a lot more to think about from a tax standpoint. The interesting thing, the final reg package included a list of excluded transactions that they aren't making brokers report currently because, quite frankly, the IRS hasn't given any guidance in terms of how those should be treated. We actually talk about every one of those excluded transactions in the document in a section about unique digital asset transactions. And it's just kind of interesting how that played out because we drafted this, 2 years ago? And then to see that in the final regs was, reaffirming of our views and kind of how we think about this stuff.
Conor's crystal ball. That's what that was. But I mean, in the spirit of the industry, right? Very open source. The community really shares stuff. This is our effort to try and share some of our insights with those who care about tax. So please take it a read. If you have any questions, ask us. And updates, if you have any questions, things can be clarified, please bring those to life. Conor and I own that periodical. Okay. And, that formatting got a little bit weird. One of the things that we went deep on in the B&A is about character. And character does matter, as the phrase goes, but it's one of the topics we cover, and there's a lot of different reasons that character may matter. And we talk about character from a tax perspective, that being ordinary versus capital.
Yeah, and it's not really just on sale or disposition transactions that it matters. There's a lot of parts of the tax code where it matters what the character is of the assets that you're holding.
T-shirts on this? Wait a minute, hold on. So there's a T-shirt, character does matter. So if you want one, let me know. I've got a few we can pass out. But if you...
we're crowdfunding a T-shirt cannon for Rob.
That's right. I've got some more, but take it away. Sorry to interrupt you.
Yeah, no worries. The interesting thing is that to date, or actually up until the final reg package, I think the IRS has generally talked about digital assets as being capital assets, which is probably right if you think about the number of taxpayers and how they interact with them. Most of them probably are investing in Bitcoin or Ethereum as just an investment, right? So it makes sense that, your average person is probably just going to have a capital asset on hands. But a lot of the business businesses that are launching digital assets or perhaps launch a decentralized application and are accounting for some of those transaction flows, they might have a really good argument to say, no, these aren't capital assets in my hand. They're actually ordinary assets under 1221. Typically, we see, an argument can be made under 1221A1. That's property held in the ordinary course of business for sale to customers. And I think there's a few unique things about the space that can differentiate it from your typical ordinary analysis when it comes to like traditional financial instruments, right? Where you're really in that space just dealing with, am I dealing with a trader or an investor? We actually have businesses that use these assets in their ordinary course of business. So there's new fact patterns to consider here. And we do find this topic coming up quite a bit.
And most of the companies that we see in this space, they're going to have a mix of both. And that's okay. In fact, it's pretty normal, right? Eventually, people more and more are going to use crypto as payments, as Pat talked about this morning. So using it in the business is a thing. And you might want to have a little bit set aside in your treasury function, held for long-term investment. And as long as you're being very particular and intentioned about what you do with it, and this gets back to wallet structures, that's fine. There's actually a lot of planning you can do in this topic, as are depicted on the slide or on the t-shirts.
Yeah, I think you can really help build your case with appropriate wallet segregation that just lines up with your operational flows.
Yeah. Old school case law talks about how you can actually change your mind with clear intentions and management, saying, look, we held it here for investment purposes, now we're going to use it in the business. That's fine, as long as you're intentioned about it, and it's not like the eve of kind of decision before you're going to monetize something. Okay, a month ago, we got some new Treasury regulations, and it was a big package. It was significant, coming in the form of regs and also a meaningful rev proc. The Treasury regulations go deep into 6045, which is broker reporting. We're not going to go deep into broker, but very important that we realize that all of those who have some broker-like responsibility within the broader scheme of things are impacted and needs to study these rules because they do come into effect for transactions starting on or after Jan 1, 25 for some transactions. Also, in addition to the broker reporting piece, there was a lot on basis tracking. And what do you do with specific ID? And there was a lot of instructive guidance, some of which had been discussed before, but it really landed well and thoughtfully so. And we're going to go deeper into that because it really impacts everybody, regardless of how you're custodying, what you're doing with digital assets, those held for capital purposes. So on the last slide, we were speaking about capital versus ordinary. The 1012 regs apply to capital assets only, and that's really important. There's other rules that impact ordinary. But this is really a tour of thinking, what do we do with, what did the reg package say specific to 1012? So first off, there was a lot of distinction between the assets held in self-custody, which some of us do in the room, and also held with brokers. Slight differences to each, but even when, and Conor will get into this, even when the broker regs come into full force, the detail probably won't be good enough for you as a taxpayer to take whatever's off the 1099 and just put it on your return for a bunch of reasons. That means that your books and records are critical. They talk a lot about the timing that you make an identification. And they're very specific, and they said that the time you make the call, if you're going to use specific ID, if you're going to choose that tranche, you need to make sure there's documentation of choosing that tranche before the transaction. And some of you guys have been involved in this traditional securities for a long time, they're like, that seems weird. Under the old rules in traditional securities, you had until the date of settlement, which is typically 2 days later. Treasury talked about this in the preamble, and they said, we get it, except that crypto settles pretty fast, sometimes in seconds, sometimes in 30 minutes if you're going to go through 3 cycles of Bitcoin. And so they're like, we want to make sure that you have contemporaneous documentation that you chose that tranche before you make the transaction. That's different. It's also really hard. And so we'll talk about that a little bit, how people are wrestling with that. But the timing is critical. The regs also clarified transaction fees. If you saw the proposed regs, they had this weird thing about splitting transaction costs and capitalizing part on the assets you bought, and then disposing of part on the asset you sold. Split transaction costs. What are we talking about? This is totally new muscle. The final regs pulled that out. They said all of your transaction costs are going to get part of the disposed asset. So that worked out pretty well.
Yeah, I'm sure that was a big relief for everybody at Bitwave, not having to deal with that headache. So.
That would have been really hard to program, right, Pat? So there's also a lot, and we're going to get into the RevProc and what this allowed in a minute, but this is basically an acknowledgement by the IRS and Treasury saying, look, we know that basis reporting has been all over the map. People have been doing it different ways, some more thoughtful than others. We're going to give you one chance. Between now and January 1st, you can think about your basis and you can reattribute unused basis to different tranches of digital assets. Pretty interesting opportunity to clean things up, maybe some planning in there, probably avoid some risk. They talk a lot about spec ID versus FIFO being a method of accounting. Sorry, not a method of accounting. So you can choose as you wish.
Right, I think they call it a method of specific identification. So not a formal method of accounting. They do, clarify in there, just like traditional financial instrument transactions, you can switch between one type of specific identification to FIFO, and it's not a change in method. It's how you recover your basis under 1012.
So let's get a little deeper into what does spec ID mean for custodied assets, Conor?
Yeah, so if you think of a relationship with a custodian, once they really have this cost basis reporting obligation and they're tracking the basis of your covered assets, so that's digital assets that are purchased on their platform subsequent to 1/1/26, they will be, they're going to kind of have to have some methodology to enable their customer base to specifically identify the lots that they want to sell. The important thing to keep in mind there, though, is the date, right? That means we're going to be living with at least a year of this kind of purgatory state where, yeah, I know what I need to do to spec ID, and my assets might be with a custodian, but I may not have that ability or a user interface to actually specifically identify the assets that I want to sell. So throughout 2025, and realistically, on a go-forward basis, it's important to keep good books and records and have a system in place where you can identify what you're transacting with contemporaneously with those transactions. And I know it gets kind of hairy because we're dealing with multiple systems, one that's just tracking my internal books and records, and that might be where I make my spec ID prior to brokers actually providing this ability. But it's really important that you kind of get this process in place, and it might make sense to continue on with that so that you continue to have your books and records. So if the broker disagrees with you having made a specific identification, you could still have an audited trail in your own books and records and be able to support what ultimately you put on your tax return.
This is a really important point because the way that the user interface for brokers or even custodians, and you may have different parties, right? There may be a broker separate and distinct from your custodian. You got to make sure that audit trail of the documentation is really important. This gets back to the timing reference. They're very clear. You need to make sure you identify which tranche it was, such that is traceable, that timestamp happened before the transaction, and importantly, that it follows the same flows, meaning if you instructed it to happen there, it actually moved there. A lot of people with multiple custodians, or some in self-custody and some held under a custodial framework, you got to make sure that the instructions that you give on that tranche follow the deemed physical location of where the stuff sits. So they're very, very clear. Yep. Compare that to self-custody, Conor.
Right. So self-custody is a little bit different in that we don't have that natural third party that we're going to be directing instructions in terms of what asset we want to sell, right? It's self-custody, so I'm doing this on my own. So I think the real important piece here is making sure that you have some way of documenting your intent to move or sell a specific asset. Now, if we think about kind of where self-custody is at right now, I'm sure everybody here that's used any type of wallet, when you open up your browser extension or log into Ledger Live, what do you see? You see your balance of your addresses in that wallet, and you don't really have any kind of segregation of tax lots or any of that granular activity. You're dealing with an interplay between two systems, your accounting system where you are tracking those tax lots, and the wallet that's actually enabling you to process that transaction. So there's going to need to be some marriage between those two, right? You're going to need to go into your accounting software, specifically identify what asset you want to transact with, and then make sure that you're moving that asset from that same wallet that you identified in the software to really make sure that you're good here. I think the other thing to consider that does get kind of hairy is we know how people generally transact with self-custodied assets, right? A lot of people have a cold storage wallet, a hot wallet, and then they might actually just sell their assets on an exchange. So if I wanted to really recover basis from an asset that's sitting in cold storage, I'm going to have to identify that asset that I'm moving to my hot wallet, and then identify that asset again when I'm transferring it over to my exchange account, and then ultimately have that sale transaction in my exchange account. And I think best practice, at least as of today, would be to identify each of those ahead of the transaction and make sure that you're moving the appropriate assets.
Seems burdensome, but something to think about so that your intentions are they're withheld if you ever come under exam, or just for somebody to file a tax return. A lot of good best practices here.
Yeah, I think the other thing to talk about here is methods of specific identification when you're self-custodying. There's not clear statements in the self-custody regulations, but we do think that they would apply similar to standing instructions for a custodian, right? But the important thing in this respect would be identifying and documenting what method of specific identification you're going to be using and consistently applying that. So, when we talk about a method of specific identification, that could be FIFO, which would be the same as default. So, question if you really need to document anything at that point. But you could want, maybe you want to use HIFO, right? I want to use all my highest basis assets first. You really would need to make sure that you have that documentation, probably on a wallet by wallet basis, and that you're consistently recovering your basis in that method.
And there has been some discussion on FIFO. You're like, the spec ID stuff is too hard. Let's just do FIFO. FIFO, it seems like it needs to be documented and executed on a wallet by wallet basis. The concept of global FIFO doesn't look like that was well acknowledged.
Well, yeah, I think that was substantiated with the RevProc that the IRS issued. But you can really land in a different place if you're determining FIFO on a global or universal basis versus a wallet by wallet basis.
They did talk about
I will also add just real quickly, I think it is nuanced as to what the IRS is saying when they're saying wallet in terms of self-custody. It's interesting to note that they don't actually mention wallet in the body of the regs for self-custody transactions, although they do discuss it in the preamble, and they make references to identifying an asset and then moving the asset from that wallet. So I think that we will see advisors landing on different places in terms of what that actually means in a self-custodied capacity.
And so to the earlier point made, if you have a clear vision about how you want to execute these transactions using vernacular and emphasizing addresses versus wallets or some other receptacle, making sure that it's clearly documented, consistently applied. Long-standing principles in case law that say as long as you're consistent and it's rational, you got a pretty good leg to stand on, but stay with the herd. Let's talk about the RevProc, because this was a nice gift that came at us a month ago.
Yeah, I think so. I mean, it was kind of an implicit gift that you can take from it the thought that the IRS might not challenge your previous activity because they're allowing taxpayers to reattribute unused unit basis to their current holdings. Although I should note here, they didn't explicitly say that they wouldn't challenge anybody that might have been using a methodology that they think doesn't apply historically. But it is kind of implied. So we'll see ultimately if they challenge anybody. But ultimately what this allows taxpayers to do, it's really geared at folks that have been using a universal or global view on their holdings. and perhaps recovering basis on that on a FIFO global methodology. So if you think about somebody that has a self-custodied wallet and an account at Coinbase, and the assets in their self-custodied wallet are the earliest acquired, they might have recovered that basis when they sold assets that are in their Coinbase account. So what this does is say, hey, realistically, if you were respecting this segregation as we've described in the regs, you have assets in Coinbase, or basically you've recovered basis that you no longer have, or that you should still have. So this allows you to reallocate those units between different tranches or pools of assets.
The timing of this is interesting. So if you are one that is constantly selling digital assets, you have until January 1st of this year, coming up quickly, to make sure that you build support for on units, basis, and timing of each of the tranches you care about, where they sit, make sure you reconcile that to what you have. This is your unused basis, and then make an intention about where that sits, and then prospectively, you can use that by January 1st. If you don't transact, that's what the RevProc says. If you don't transact all the time, as long as you have that documentation in place before you first transact in 2025. And if you're not selling at all, you're just holding, but you want to take advantage of this, then you have until the extended due date of the tax return, which includes Jan 125 in it. So for most people, that's going to be your 25 tax return due October or September of 26. So there's a little bit of leeway there. Unless you transact all the time, you got 5 months.
And a couple of quick call outs on this. This is only applicable to capital assets. So ordinary assets, you would not be able to reattribute that basis. And I think that's...
Yeah. This
Oh, wait, sorry. I got it. This does not allow you to kind of monkey around with your per unit basis or your acquisition date, right? Like your existing per unit inventory needs to remain the same. You still have those same units that were bought on the same date with the same basis. It really just lets you kind of point to which wallet or segregated pool that basis of those units sits in.
This should be something that 100% of us are thinking about. Even if your books and records are super tight and you don't have a lot of tranches, everybody should say, how can I be thoughtful about this RevProc? Anything I should do or can do to protect from risk or institute from planning. So nice little gift, but don't sit on it too long. And since it applies to everybody, we were in quick dialogue with Pat and to make sure that Bitwave was accommodating of this feature, because like we're talking about, I mean, he was on it, right? This thing's only been published a month, and Pat's like, I got it, I'm on this, like, let's build it. And so important to say, as we've been reemphasizing, the significance of books and records and having your intentions on a contemporaneous basis built into books and records, really hard if you're self-custodying, right? And so what Bitwave has done is said, how can we be thoughtful about this? How can we help our clients in this space?
One of those funny times where a month ago we released our official selected spec ID is what we call it, which is the ability to basically go in, and we were powering this Google Sheets where you could actually take your lots and select a lot directly. And then of course, 2 weeks after we released that feature, the IRS is like, so over the last couple weeks, we actually built out a really quick new feature here, which we're calling our contemporary selection feature here. So it's part of our inventory views. So the great part about this is if you're already using inventory views, it's as simple as creating a new view that uses the new allocation strategy. There's gonna be a little bit of trick on how you actually do your reallocation, but that's where you call Deloitte and Bitwave, and we'll help you with the project on that. It's gonna be fun to do. It's gonna be fun, guys. It's gonna be fun, I promise. But then once you actually have that and you're using it on a go-forward basis, you can actually come in here. We're going to show you your current open lots that are sitting out there. You can select it. We're using the estimated tax impact there is based off of the current price that we have coming off of the books. You select that, if I could click it. You select that. That allows you to now do your contemporary selections. You say, okay, guys, I am selling this lot. You can choose different amounts if you want, whatever you want to do. But this is the lot that I am selecting at this moment in time to be used next. Notice we're putting the wallet there because this, as Conor mentioned, you got to be really careful that whatever you make your selection for here, you then go and actually use that. When you go and make your trade, you have to do it correctly. Like you will be in a bad place. So it's almost like we're going to treat this kind of like when you're sending $1,000, you always send that 50-cent transaction first. I kind of think we're going to see that where you're about to trade $100 million, you do a little tiny transaction first on that. So you hit confirm there. Someone behind stage is actually going and doing that trade, so you're going to see it pop up here in a second. So a couple important things is we're picking up that contemporaneous timestamp. So we have 16/13/47 right here that then is obviously before the actual trade timestamps. It comes out as an audit report, so you have really, really good contemporaneous selection of it. And then once the trade has been made, you just come in here and do that match. You say, okay, this particular trade, this particular disposition, whatever it is matching to this selection that I made at this point. Hit confirm match. It updates it. You're all set. You now have full records for contemporaneous selection here. So this was Rob had to spend hours explaining this to me because we try to get this stuff, but it's complicated. But this is now ready to go. So if you're looking to do actual contemporaneous selection ID, you're getting ready for Jan 1. We've got this all ready to go. So thank you guys for helping me so much with this, and thank you for this amazing presentation.
Thank you all.
Thank you.
Thank you. If you